Hi. All right, so today we're going to talk about Chapter 4. Now, Chapter 4 is going to take us in a little different direction than we've been thus far. Chapters 1, 2, and 3 were mostly about service businesses, businesses that provide a service of some sort. Chapter 4 takes us to a new type of business called a merchandising business. A merchandising business is what you and I consider a retail store. They buy and sell stuff. The big thing about a merchandising business that's going to be introduced in this chapter, or one of them, is called merchandise inventory. Merchandise inventory implies that you have to have the stuff in your store before people will buy it. So you've got to have stuff in stock. Merchandising businesses include retail companies and wholesale. Retail are the ones that we have most familiarity with. Now, when we're talking about merchandising companies, we have two kinds of costs. First, we have the cost of the product, whatever we're going to sell. All costs incurred to acquire the merchandise and make it ready for sale go into that product cost. The other costs we have are obviously selling and admin costs. That's the cost of the business in order to sell the product. Those are also called period costs. So product costs, period costs. Now, inventory can be allocated between asset and expense accounts. So we have beginning inventory plus inventory purchased during the period. That gives us everything we had available to sell. That's called cost of goods available for sale. Now, cost of goods available for sale is split between two things. One is what's left in the merchandise inventory. That's the stuff we haven't sold yet. That's on the balance sheet. Now, on the income statement side, we have something called cost of goods sold. And it is just what it says. It is the cost from here of the stuff that we sold. That goes on the income statement along with the sales revenue for selling that stuff. So sales revenue minus the cost of goods sold gives us a new term, gross margin. This is going to go into a discussion that Chapter 4 brings us to about something called the multi-step income statement. Now, our income statement in Chapters 1, 2, and 3 were essentially revenue minus expenses, net income. Pretty simple. Now, because we have to pay for the goods in a merchandising business before we sell them, we're going to include here now a step that subtracts the cost of the goods that we sold from the sales revenue, giving us gross margin. Now, gross margin has to cover all the rest of the costs of the business plus profit. Net income. The inventory, there are several ways to value the merchandise inventory. The system we're going to be looking at is called perpetual. And it's called perpetual because we have one merchandise inventory account and all of the transactions that affect the inventory affect that one account. So if we purchase merchandise inventory, the merchandise inventory account goes up. If we sell merchandise, it goes down. So everything that happens to merchandise inventory happens to that one account. And what the perpetual inventory system allows us to do is to look at the merchandise inventory account and at any particular time get a fairly good picture of the value of inventory that we're holding. All right, so we're looking at this event number 2. It says that we purchased merchandise inventory for $14,000 cash. All right, so this is a cash transaction, so obviously we purchased merchandise inventory. Merchandise inventory is an asset. It's something we own. So we're going to debit merchandise inventory for 14 grand. Since we paid cash, we're going to credit cash for 14 grand. And you'll note that since both of these are assets, this is called an asset exchange. So we now have exchanged cash for an inventory of stuff to sell. And on the statement of cash flows, that is an operating activity. Now, if you look at this, it says event 3A. The ones that we've looked at in the past, it was a whole number. This has an A after it. The A indicates that there's probably a B, maybe a C, maybe a D, and so forth. And that's the case when we have sales of merchandise, because the first part of recognizing the sale is recognizing the revenue. In this case, we sold inventory for $12,000 cash. So we're debiting cash for 12 grand and we're crediting sales revenue for 12 grand. So we've now recognized the revenue, but there's something else that happened here. We sold inventory. So we now have to, in B, go to the merchandise inventory account and reduce it because we don't have it all anymore. We sold some of it. And when we sell merchandise, the debit goes to COGS, cost of goods sold. So we debit COGS for $8,000. We credit merchandise inventory. We've now reduced the merchandise inventory account to represent what we actually have left. And because there's no mention of cash here, there's no statement of cash flow effect. So this is all of the transactions that were shown in the textbook that you can see when you read the chapter. The things that we're going to look at right now are, number one, the new accounts, merchandise inventory. So we bought 14,000, we sold 8, leaving us a balance in merchandise inventory, a debit balance, by the way, of $6,000. On the cost of goods sold side, we debited cost of goods sold for $8,000. So that's going to show up on the income statement. And there it is right there. So the income statement shows the sales revenue of $12,000, COGS of $8,000, giving us a gross margin of $4,000. We're reporting here $1,000 of operating expenses, which is essentially selling and admin, giving us a net income of $3,000. Now, it'd be a good idea for you at this point to take that $3,000, divide it by the sales, and that'll give you the net profit percentage. On the balance sheet side, there's our merchandise inventory. So we have $6,000 in merchandise inventory left. And that's pretty much the change on the balance sheet. On the statement of cash flows, and notice, statement of cash flow says outflow for inventory, 14 grand. So the statement of cash flows shows everything we paid for the inventory. The income statement shows what did we sell, 8,000, and 8,000 from 14 shows the balance of merchandise inventory on the balance sheet of $6,000. So we're looking at the statement of cash flows. We also had outflow of $1,000 for selling and admin. So we have $3,000 cash inflow from operating activities. And we're going to stop here and I'll pick us up again on the other side in the Part B video.